If you want patience as a trader, I need to tell you something. The truth is, impatience in trading isn't about wanting money faster. It's about an unresolved insecurity. When you don't trust your system, you feel the need to do something. Click, adjust, force trades. Most gurus tell you the hardest part of trading is losing. It's not. The hardest part of trading is doing nothing. Sitting on your hands while price chops, while other people look busy, while price takes off, while your emotions beg you to act. Because it's not the thinking that makes you more money. It's the waiting. In this video, I'm going to show you the art of sitting still until the money moves. This is how you develop patience as a trader. Let's dive in. Scenario number 1, the midday slump trap. Imagine the London session was quiet and New York session is choppy. You're $500 away from your profit target and you start looking at different time frames, the 1-minute chart, just to find a scalp, just to find something that you can finish the day, show you're profitable. Now, if you don't hit your target today, are you wasting your time? Was all that for naught? I'm telling you, productivity in trading is not measured by the amount of money that you make. That's the end result. That is the symptom of being a productive trader, but the productivity is measured by the quality of setups you avoid, not the number of hours you spend clicking. Scenario number 2, the friends P&L FOMO. Imagine you're sitting on your hands because your setup wasn't formed. You're doing a good job. But meanwhile, in a Discord group, or some other trading feed, Twitter feed or something, it's blowing up with people catching a move that just wasn't in your plan, so you never took it. And you're thinking, am I being too picky while everyone else is getting paid? Should I slacken my rules? Should I change them up a bit? But following someone else's winning strategy is the fastest way to developing a losing habit. You're missing out, or are you? You're not missing out. You're actually staying in business because your trading habits match your personality, and you got to be okay with that. Scenario number 3, the break-even boredom. Imagine prices hovering near your entry for 3 hours. It's not moving. It starts to just go sideways like a flat line. You feel the urge to close it out, just to be done with it, or just to reset for a more exciting trade later on. Question, is that a stagnant trade? Is that a sign that you're wrong? Scenario number 3, the break-even boredom. Imagine prices hovering near your entry for a long time. Imagine it should have taken off by now, gone towards your take profit, but it's moving like a flat line. It's not going anywhere. You feel the urge just to close it out, just to be done with it, or reset for a more exciting trade later on. Question, is that a stagnant trade, and is that a sign that you're wrong? So the answer is, a boring trade is often a healthy trade. If it's too much, then it spikes your emotions. But if you don't have an emotional spike, your heart rate or your emotions is flatlining too, that is a healthy attitude. Boring doesn't just mean doing nothing. Boring means it doesn't spike your emotions up or down, and it means that's where you can be, and you are objectively analyzing rather than emotionally analyzing because the emotions spike. Impatience at break-even is just, your ego might be demanding entertainment. That's no way to be trading. Scenario number 4, the news event. A high-impact news folder like NPI or FOMC or jobs or, real estate or new building construction claims, whatever it is. It's coming up. Your system says, stay out. But you see the massive candles and you start to think, if I just catch a piece of this, I don't need the whole thing. I'll pass the entire challenge today. So the question is, can one lucky gambled trade really be that bad if it gets you funded? Well, the truth of the matter is, using luck to pass funded challenges ensures that you will probably use luck to manage the funded challenges. Luck usually has a way of running out, and you should trade based on patience, strategy, and discipline rather than getting lucky. Scenario number 5, the gap up panic. Imagine the market opens with a huge gap. You missed the initial move, so you feel like the train has left the station and you want to chase the price at a terrible risk to reward. Just terrible. So the question, if you don't get in now, what if the market never pulls back? And the flip side of this is, the market is an infinite stream of opportunities. You don't chase trades, you just wait for the next setup. If you are chasing trades, and it might beg and start a retracement or a pullback, you might get stopped out, and it's better just to wait and have the patience just to wait for the next proper setup. Okay, scenario number 6, the drawdown, the quick fix. Imagine you're 2% down on your prop firm account. the buffer is catching up to you, or the how much you have left in the account is catching up to the buffer, or you're getting closer. You want to make it back before the end of the day so you can sleep better, feel better about yourself, whatever it is. You increase your lot size on a, less than ideal setup. Is this a good idea? Even to get back, I'm just going to say this. Revenge trading is an attempt to heal your ego, not your balance. The slow way back is actually the healthy way back. Scenario number 7, the perfect setup that doesn't trigger. You've waited all day. Price comes within 1 tick or 1 pip of your entry limit, and then it takes off without you. You want so much to buy at the market just to get in it because you know it's going, but you're chasing. So, did you do all that work for nothing? You waited all day for it. It finally came so close to your setup. You just want it because it's close enough. I'm telling you right now, a missed trade is a $0 loss. A chased trade is a potential 1% loss plus the mental tax of being a disciplined trader who broke their rules. That won't sit so well the rest of the day. Scenario number 8, the redundant confirmation. Let's suppose that your entry signals are all there, but you're scared because your last trade was a loss. You've got some scar tissue, if you will. You wait for one more candle just to be sure, and by that time you're convinced, but your move is halfway over. So the question is, isn't it smarter to be extra cautious? Well, hesitation isn't caution. Hesitation is a lack of trust in your edge. It's a probability that plays out over the course of several trades, not over one trade. So analysis paralysis is just impatience in a mask. Scenario number 9, the Friday afternoon hero. It's Friday, 2 p.m. You're slightly up for the week, but you haven't hit your goal just yet. You look for one last trade to end the week on a high note. You want to finish the weekend, have a great weekend, despite the low liquidity. Question? Don't I want to go into the weekend feeling like a winner? No. A winner is someone who keeps the rules. Overtrading on Friday is how you pay the broker for your own weekend stress. Don't do it. Don't do it. Scenario number 10, the multi-pair distraction. Let's suppose your main pair is consolidating. You start scanning 20 other pairs you don't normally trade because you're looking for anything that's moving. You just want to trade, even if you don't understand the price action. So the question is, shouldn't I be looking where the action is? No, you should be looking where you're used to. So mastery comes from knowing one market deeply, not knowing 20 markets shallowly. If your pair is sleeping, you should be too. That's how it works. If you like this video, like and subscribe. And if you want to go deeper and make impatience impossible, and you want to stay consistent every day, check out the link in the description. I think you'll be pleasantly surprised.